Do you think you have a brilliant idea? What is stopping you to make it become true? Money? Well, that's what many people think. So here I will present you some key learning from the course on Entrepreneurial Finance from ESADE Business School. In order to get funds for your startup, if you want to avoid classic funding options as bank loans, you can look either for venture capital, which is a way of corporate financing by which a financial investor takes a participation in the capital of a private company in exchange for cash and strategic advice. Also, you can look for business angels, which is a private investor that invests part of his own wealth and time in early-stage innovative companies. Apart from getting a good return, business angels expect to have fun. What are the main differences between them? BAs invest their own money while VCs invest other people's money. Also, BAs do it not only for profit. BAs expect much lower IRR than VCs, who expect something around 60% a year. BAs have a much faster decision-making process, while a company can keep up to almost 1 year negotiating with VCs. It's important to know that BAs are only focused on very early-stage companies, while VCs are pretty much focused on startup or growth-stage companies. BAs are always more involved on the daily business, while VCs are not so present. Also, BAs have longer investment period, while VCs usually have a cycle from 3 to 5 years. So all of them should not only found your company, but also help you to reach your objectives. That's why it's usually a great advantage to be venture-backed. Venture capitals usually invest from 100,000 euros up to millions of euros. BAs have a much lower investment rate. They usually give funds from 18,000 to 45,000 euros. But still, they represent around 3 times what's being invested by VCs. So, what do they care? First, they want to see a consistent business plan. They also care about the management team. Most of investors even don't look to your BP if they don't like the team. They also care about the knowledge in the sector. Investors usually are specialized in some industries. They need to believe on your products or service. And obviously, they want a potential return on their investments. So why do they might refuse your proposal? There are some important points that cannot be weak. Never present a BP lacking relevant information. Be sure the investor you look for is up to your sector. They might just think that your proposal doesn't fit to their expectations, or even think that they would take too much risk by investing in you. So how to build a perfect business plan? It should contain all of the following items. First, the executive summary containing the team's experience, commitment, and skills to meet the plan. A description of the product or service. A study about the market you are joining. A detailed analysis on the competition showing why you are better than them. Sales and marketing forecasts. Details of your operation. A financial plan specifying your assumptions. Your expected human resources and key employees. Contingency plans with different scenarios. And finally, an appendix with additional information. So, going deep on the financial plan, it basically allows entrepreneurs to estimate how much money and when it will be needed in order to start up a business and to keep it running. And it should answer a key question. What is the cash burning rate? To do it so, it's necessary to take into consideration 3 main financial needs. First, the characteristics of operations. Have in mind the number of employees, fixed versus variable costs, investment in fixed assets, and minimum efficient scale. Second, the sales growth and profitability level, thinking about the nature of business and competitive situation. Third, working capital policy, which is the inventory and the credit and payment policy. After that, you will be able to do a concrete cash flow. But there are still some important considerations that should be taken into account. The beginning cash has to be positive every year. Additional funds have to be negotiated with time. Don't wait until the cash is empty to start looking for money. The working capital policy is key in a growing company and it demands plenty of money. So, once you choose between a venture capital or a business angel, be prepared for the following step by step to successfully convince them that you are the one. In the first contact with the investor, you should pitch them and handle an executive summary, which should contain the size of the company, the actual stage, the sector of activity, and the stake proposed. Then, if they are interested in you, they will set up a first meeting, where they will want to understand your business and meet the management team. Have your full business plan prepared so the investors can check quickly the team and the market before proceeding to put more time in project. You should state the experience of the team, the need for the product on the market, the level of competition and everything else. Then the investor will probably analyze your business plan. If they are still interested on it, they will call you for a second meeting to clarify doubts and questions. Hopefully they will proceed with you, handling you a term sheet which contains the main conditions of the proposed deal. Be prepared to pass through a due diligence, which will be an in-depth review of the company's account, contracts, payment of taxes, and etc. After that, they will give you the results of all audits and start the preparation of final contracts. Be prepared to negotiation phase, which will include the amount to be invested, the equity to be taken, the price per share, the number of members in the board, veto and minority rights to protect investors, and finally the proposed terms for the VC's exit. This is timing, way of exit, drag-along and tag-along rights. It's useful to hire a good lawyer on this part. So finally it will come the closing of the deal. It is accompanied with the preparation of contracts, which will take some time. It will specify important terms as the detailed monthly financial plan, the conditions if financial plan is not met, and etc. It's important to understand how they evaluate your company and how they get to the final amount of equity that they will take. Have a look on this graphic. It shows the step-by-step that all investors do when analyzing a company. First, they calculate your company's value on the time they expect to exit. Then, they calculate the requested fraction of the company necessary to meet their IRR. This will generate the number of shares involved on the deal and the estimated price per share. Have in mind that they take in consideration many variables to get those numbers, as your initial sales, your sales growth rate, the time to exit the business, your profit margin, and finally they compare your company to some other similar company. It's useful to run the same process as investors do in order to reach a better deal for you. Finally, some important advice for you. This process needs to build trust between the parties. Also, be prepared and confident of your proposal. Finally, good luck!